Hello, I'm Stephen Hammond with Christian Values Investing, and today I have with me Grayson Shaw, an investment advisor rep with Christian Values, and today we're going to be discussing some of the worst performing stocks over the last 30 years, and I think you will be surprised to find out which companies actually perform the worst. And Grayson, let's start this off. Kind of introduce this first company we want to talk about, and where it started and how high it went up, and actually what it's doing today.
So the first company that I found is actually called BlackBerry, and this is one that I remember from when I was a kid. You know, my dad, when I was 7 or 8 years old, had a BlackBerry, and I would play Brick Breakers on his phone, and I think a lot of people can remember those because they were a real big deal before the iPhone came out. Now the cool thing is, since inception, it started at about $1.48 per share, and right now it's trading at about $5.86. So they're still in business. But the thing that really hurts to look at on this chart is where it peaked out and where it is now. And that represents about a 96% loss, which really hurts. Do you remember anything about BlackBerry that might have caused that?
Grayson, what I can recall about BlackBerry is when they came out, what was so interesting about them is they kind of had a pencil that you could go with it and touch things on your screen, and they worked almost like taking notes, and everybody was really fascinated with them, and everybody had to have a BlackBerry. It was kind of the state of the art iPhone 15, 16, whatever it is today, and people just had to have that technology. But technology shifted, and they were kind of left in the dust. Grayson, tell us about that next company.
So the next company is going to be GE, and this is actually one that you might be surprised is on this list because it was actually one of the biggest companies in the world at one point. It went public in 1970, and it's actually done pretty well from inception to currently if you're just looking at the percentages. It's performed and returned about 5,800% since then, but the thing that we want to point out today is that it peaked in 2000, and since 2000, and if you go and you look at about September of 2022, it was down 86%. And if you look a little bit further, it's still down today about 27.8% since its high 25 years ago. And so, if you'd held this since 1970, you might be okay. But if you're like most people and you've been investing in the last 25 years and you bought it somewhere in that time frame, especially when it peaked out, it really just hasn't performed very well. And so this is just an example of really a big-time collapse from a blue-chip stock where it peaked in 2000 and it hasn't been able to do much since then.
When I first started in the business in the late 80s, the CEO of GE was a guy named Jack Welch. And if you go look at his track record for over the 21 years he was there, GE did very, very well. It was buying out companies, was doing a lot of mergers, and the stock, Grayson, went up during that time period about 4,000% until he retired in 2001. So GE was a household name in the 80s, 70s, 80s, 90s, early 2000, and it just really kind of fell from grace.
Sometimes that happens, and that's why we're doing this. One of the things that we'd like for you to understand is that even though a company is performing really well, that doesn't guarantee that it will continue to do so. Let's jump into this next one. It's Nokia. So to start off with, let me preface this by saying that if you'd bought it when it began in 1994, it's increased to about 228%, and it's actually still in business. But the thing that you've got to look at is it also peaked in the year of 2000, and since then it's down 92%. And that's a pretty big hit. That's not really something that you'd want to stay in, especially for a long term.
Nokia is a company in the early 2000s, 2010 or so, was in the cell phone business, and they kind of made a name for themselves where people were really enjoying Nokia phones. They were bought out by Microsoft, and only about 2 years later they went back public. Nokia at one time was a real well-known company, kind of like years ago Motorola was, today kind of like the Apple iPhone, but it's actually like all the rest of them we're discussing today. It's kind of had its heyday, but it's on its way out.
The next company that we have is Kodak, it's got a pretty ugly chart, to be honest with you. This is one of the first ones that we have that's performed very negatively for almost its entire existence. From start to finish in 2025, it's still in business, and it's down 68% since its inception. From its highest point to its lowest, it's down 93%. That's a butt whipping if I've ever seen one. This next company that we're going to talk about is Lucent Technologies, and it's the first one that its chart looks like this that we're going to talk about. If you'll take a look with me, it grew about 750% in its first 3 years, which is a really big-time growth. A lot of newspapers would have been talking about this. A lot of brokers would have been pitching the stock really hard because it had a great track record. But then if you look, it really just took an absolute nosedive over the next 3 years and lost almost all of its growth and even some of its previous value. And so it's down 71%, or it finished down 71% from where it started even in 2006 when it stopped being traded. This was definitely something that you should take note of, because even a stock that's performed really well in the last 3-4 years can always have something like this happen, especially if fraud comes out and people find out that its value isn't really what they thought it was.
I remember, Grayson, back in the late 90s, early 2000, before the dot-com bubble, what we had is we had CNBC coming on, and they were touting Qualcomm, they were touting Lucent Technologies, they were touting all these stocks, and they were really growing up like a rocket. I even had people to come to me and say, this investing is so easy, it's like shooting fish in a barrel. And what they were thinking is that anything that they heard on CNBC was the gospel, they could buy it, and it was just going to go to the moon. But you see, those companies that went up real fast like Lucent is actually now really hurting today. So it's another reason you maybe need to consider diversifying your holdings. But Grayson, we have another company you would like to talk to us about.
Yeah, the next company is Xerox, and all of our favorite business guru, Robert Kiyosaki, he used to be what he called the worst Xerox salesman in history. And so we know about them, and really they had their heyday in the 1990s, in the late 90s especially. But their stock chart just really has not looked all that great. They started somewhere around $50 in the 70s, in the early 70s, and really since inception they just have not been able to do very well. They peaked out in about 99, 2000, but what ended up happening is they're down 81, almost 82% over the lifetime of the company. That's not a very good chart.
Xerox has been out a long time, and bathroom tissue. People would ask you, do you have a Kleenex? And the Kleenex was a brand, and so many people looked at when you went to make a copy, you went to make a Xerox copy. Back in the day, they were so popular. But that doesn't mean because you're popular today that's going to continue on that route somewhere down the road. And Xerox is just one of those companies that have sold off and hasn't really been able to keep up with the times.
One of the most notable victims of the dot-com bubble was Pets.com, and I was actually just with a fellow who was telling me about their downfall. He was saying that they spent several $1 million on a Super Bowl ad, and they were just never really able to recover from that. But if you take a look at their chart, it's obvious, and it shows. They started at $11 per share, and they didn't last very long. They started in 1999 and only made it to mid-2000 before they went out of business, and the lowest their stock ever got was 6 cents. You would have lost almost everything if you'd invested in them.
Yeah, some of those dot-com stocks, they were started up. Everybody wanted to get to the market real fast because they were thinking there was so much money to be made. We had a bubble at the time, and so many of these companies did not have a financial plan for success. They were thrown out into the market, and just over a short period of time, a lot of them went belly up.
Another dot-com example, and one that was down from the life of its existence on the public market, is one that's called Nortel Networks. A lot of people were familiar with this company because if you look at the chart, it had a crazy amount of growth. It started out about $500 a share and got up over $8,000. That's big-time growth. And in fact, it had an astounding 2,753% of growth in 10 years. That's something that wouldn't have been able to be ignored. But from 2000 to 2003, about the time of that dot-com bubble, when the planes hit the Twin Towers and there was all this volatility in the market, it lost almost all of its value. It didn't end up going under until 2009, but it basically fizzled out until that point. WorldCom is another example of a company that did really well, would have gotten a lot of headlines. It was up 9,674% from its inception all the way until its peak in about 1999 in June. And so what would have happened is if you'd put $1,000 into this, you would have had pretty close to $100,000. But the crazy thing is, over the next 6 months or so, you would have lost 99.9% of that. Just a massive loss in a short amount of time. And so what the old saying is true: the stocks will take the stairs up and then the window out.
Yeah, WorldCom at the time was a company back in the late 90s, early 2000s that went up real fast. It's another one that you heard a lot on CNBC about, and a lot of people put their money in WorldCom. But it fell real fast after the dot-com bubble, and a lot of people got hurt with WorldCom.
And last but not least, we're going to talk about the blue chip that pretty much everybody knows about. In business textbooks, you always hear about Enron, but let's take a look at this chart. They started off and it looked really strong. They had a few pullbacks here and there, but from their start in 1990, 1991, they looked like a great company, and everybody knew their name. Everybody was invested in them. People had their entire 401k in just Enron stock, and it ended up peaking out at around $720 per share in 2000. But the thing that ended up happening was they found out that they were cooking the books. Some of these accounting firms ended up getting found out for working with them to falsify some of their earnings reports. And what happened was they went from $720 a share down to almost zero, and people lost pretty much their entire savings if they got too greedy and they put all their money in this company. And so they didn't follow the principle of diversification, and they ended up paying the price for it.
Grayson, that's one of the things that was on television back during this time, is the networks would interview these people that lost so much money in their retirement plan with Enron. And what would happen is the people that worked for Enron, they had the opportunity to buy its common stock, but they had other opportunities where they could hold a diversified portfolio through different mutual funds. And what all of them ended up doing is they sold out of the mutual funds and put all their money in Enron, and it went belly up. And so there was a cry on television about how Enron cooked its books, and all these people lost 100% of their retirement. And what they didn't say at the time that should have been really brought out, if they were following ERISA guidelines where they teach the employees diversification, not putting all your eggs in one basket, just like you mentioned, they could only lost a portion of their retirement instead of losing 100% of their retirement. This should be an example for everybody. Never put all your eggs in one basket. Make sure you put your portion with 7 or 8, like the Bible says in Ecclesiastes 11:2. Make sure you have a diversified portfolio so you can minimize the risk. Grayson, is there anything else you want to add before we dismiss?
Just that it's important to make sure that you're doing your research on the companies that you invest in. Sometimes you'll get into a company and you'll do your due diligence and it'll go down in value. But there are other times where something will just look too good to be true, and sometimes it's just smart to stay away from it. Something like maybe Pets.com that just came out and everybody's hyping it up when it hasn't really even reported earnings yet might be one of those things that you need to keep an eye on. So just make sure that you're being diligent. Make sure that you aren't putting money into this kind of stuff that's really a gamble that you can't afford to lose. And even with a company like Enron or one like WorldCom that were big time and that everybody was talking about and were on these big channels, just make sure that that's only a portion of your portfolio. Even a company like Nvidia today, even a company like Apple, this can happen to them. It's not very likely maybe, but it can. And the thing is, you have to make sure that you're ready for that in case that it does, because the odds are that it's not going to happen to every company in your portfolio, so that way you'll be protected. But if it does happen to one or maybe even two of them, you'll be safe and you'll be able to survive to live to invest another day.
Until next time, may God richly bless you.